Hello friends, welcome to Money and Politics. Friends, just wanted to make a quick short video today before the US market opens up. Just wanted to touch base on the price action of crude oil yesterday. So yesterday crude oil made a record and it slumped more than 90% and ended well below zero at minus 37% to be precise. And today, as you can see on the screen, the crude oil is up 78%. However, it is still at minus $8, that is well below zero. Now, what it really means, if you want to just try to make out some meaning of this bizarre movement that happened yesterday, is um, the oil suppliers, they were having so much inventory, so much stock accumulated that they wanted to pay the buyers. They wanted to give the money to someone to do them a favor to get the stock cleared. Now, this is the meaning technically. However, yesterday the price fall was not due to this, it was due to the future oil contract. It was a future market phenomena. So what really was going on is that um, there were no new takers of the oil future contracts, and the existing holders, they were not willing to carry forward their positions into the next month, and they were willing to just get rid of their positions with whatever cost it takes, with whatever loss they have to book. They were willing to get rid of all those holdings. So what I'm trying to say is it reconfirms what happened in crude oil yesterday. It reconfirms what I've been saying again and again in all my videos about the coming deflationary collapse. It underlines the deflationary pressure. There is no hyperinflation that's possible. It's deflation written on the wall. And soon after the gold touches and tests the previous highs, and it can go to maybe $2,000 and $2,100 as well, as I mentioned in my last video. However, by 2022 I predict gold between $800 to $1,000. Like, to the best of my knowledge, I believe that is going to happen, but I cannot say 100%, but 99% I think that's going to happen. 800 to $1,000 gold by 2022. And the people, the experts out there who are predicting gold at 4,000, 5,000, $6,000, I'm sorry if I am not able to understand, if I don't have that much intellect, but I want to stay away from that prediction. Now, friends, one more thing. One of my viewers asked me a question about how will the interest rates behave in this deflationary collapse. So, just wanted to tell you that Europe and Japan. Japan is in a deflationary cycle for the last 40 years. Europe is also having this deflation, negative growth for a couple of years now. And both these Europe and Japan, they are in negative territory. Now, what will happen after this COVID crisis goes and the lockdown is partially opened? It will not open fully for a long time, but partially when it opens in major countries, Japan and Europe, they will have to go deeper into the negative territory when we talk about interest rates. What will happen to US is US will US interest rates will be at zero. It will remain there for some time. And what I see, if the scenario which I foresee, if it unfolds as I see, by 2022, US can be in negative interest rate territory. And lastly, the emerging economies like India and China. India interest rate will be around 2%. So, for emerging economies, it's interesting. So I will make a separate video how the emerging economies behave during deflation. If someone is interested in that. So that's it. And just one important, very very important point I wanted to mention, friends. In the current scenario that we are in for the last 1 or 2 months, if you want to predict with more than 95% accuracy of how the market will behave today or tomorrow, for the very very short term, there are three factors. Number one, crude oil price. Number two, the bond yield, whether it's inverted or not. And number three, the bond yield of 10-year treasury of the US. So these three things will not make you go wrong 95% of the times. crude oil. For crude oil, there are two aspects. If the price range is above the viability of the oil producers and the shale oil producers, that is above $32 or $35, if it's above that and everyone is making money, price can go up, price can go down. It normally does not make that much of a difference. There are other factors who determine whether the stock market will go up or go down on a particular day. But when the stock price, when the crude oil prices are in the range, when the shale oil producers are no more viable, and the oil producers also suffered losses, at that point of time, the day the oil futures fall, 95% of the time the market will fall, unless there is something out of the blue, some other news that just make the market euphoric, right? Second, just check whether the bond yield curve is inverted or not. Let me show you on the screen. So this is the bond yield of today as I'm making this video. So you can see the 1 year treasury yield is 0.183% and 10 year is 0.578%. So what it means is the 10-year treasury yield is more than the 1 year yield. So it means it's a normal curve, it's not inverted. And in the worst case scenario, you can check for 1 month as well for to be double sure. And the 1 month should be less than 1 year. So it's normal. The moment it's inverted, that is the 10-year treasury yield is less than the 1 year, and the worst case, the 1 month is more than the 1 year. In that case, the market will fall. But the catch here is for the inverted, checking this inverted yield curve. If the curve is inverted, it does not guarantee the same day fall or the next day fall, or the very short term, or very the fall in the very short term. There can be a lag. However, this is a very good indicator of telling you where the trend is, because the trend is the king. So it tells you whether the recession is down the line or whether we are bound to go up from here. The third very important point and the most effective point is the bond yield of 10-year treasury. If the bond yield of 10-year treasury is more than 1%, the market will go up. If it craters below 1%, if it falls below 1%, the market is bound to go down, because treasury yield of 10-year treasury yield falling below 1% means the investors are losing all their risk appetite. They are flying, they are just going and hiding into the US treasuries, which is the safest haven in the world, right? So in that case, why the investors are going into the treasury and willing to take interest of less than 1% is that they are seeing no other good investment opportunity, and they are seeing, like, they are foreseeing the fall in every other asset class. So that's why they go into the US treasuries. So it symbolizes a fall in the market in the very near future. So these 3 points, friends, I've been following these three things for the last 3-4 years now, and it has given me like more than 95% accuracy on my trades. Although I don't trade much, I'm more of a long-term investor. But in situations like this, in the times like we are in, long-term investing is like doing suicide. It's like playing with time, investing your time, because you will be at square one uh, from where you started, and you can have huge losses as well. So at times like this, where you see that the markets are supposed to go down, and or there is uncertainty in the market, investors don't know whether the market will go up or will go down, because the investors in the stock market, they hate one thing the most, more than anything, and that is uncertainty. And in times like this, we know when the virus will go away. We don't know whether the lockdown will open up or the lockdown will be extended. So we are in a phase of huge uncertainty. So in times like this, doing trade is the best option. You go inside, you open a position, and get out as soon as you make bucks. So friends, that's all I have for today. Bye until next time.